Hey investor friends, I'm Michelle Markey, and if you're like me, you may have either virtually or in person in Omaha attended this year's Berkshire Hathaway annual meeting that was on May 4th. And there's so much wisdom Warren Buffett shared that I'm sure if you look back at the live stream CNBC recorded, you would get a lot out of listening to Warren Buffett and some of his fellow leaders, the future CEO Abel and Ajit Jain, the head of insurance. And I think there's so much that we learn. And if you learned some things that I haven't mentioned today, feel free to share them in the comments. I'd love to hear from you. But I think that hearing from one of the best investors, Warren Buffett, aside from the late Charlie Munger, his best friend and partner, who sadly passed away at the age of 99.9, as Buffett said, I think that we will learn and become better investors from listening to one of the best. So with that, I hope you'll like and subscribe to my video and YouTube channel. And let me share some of my key takeaways from this year's Berkshire meeting, including how I heard that there was a tribute video to Charlie Munger of some of his zingers over the years. And I know that Charlie would say things like, if they weren't so stupid, we wouldn't be so rich. And that was a kind of inside joke to Warren Buffett. And there's just so much that Charlie Munger brought to Berkshire that Buffett considers him the architect of Berkshire Hathaway, as Charlie Munger was crucial in influencing the culture of Berkshire Hathaway. And Charlie's presence was felt so much at Berkshire that Buffett even referred to Abel as Charlie when he was asking Charlie, who wasn't there this year, for his opinion, and he had turned to Greg by mistake. So it's just sort of funny how Charlie's presence was very much felt, even though we couldn't see him there. And I know that for sure Warren Buffett misses Charlie, and he came up a lot during things that Buffett would say. And this year, the bookworm that normally sells a bunch of Berkshire-related books was only featuring the Poor Charlie's Almanac book by Charlie Munger. And I hope that when folks check out that book, they get a lot of wisdom out of the late Charlie Munger as well. So with that, some of the other things I took away include how Berkshire Hathaway sold entirely out of the Paramount stake that Warren Buffett said was entirely his decision. And it sounds like Buffett is reconsidering what people do in their free time if it's not watching some of the content that Paramount's putting up there. And also what was a bit of a shocker is that Berkshire reduced its Apple stake by about 13%. And I reckon that they maybe sold about $22 billion worth of Apple, give or take, because it looks like the cash pile of Berkshire might have gone up from the fourth quarter of 2023 to the first quarter of 2024 by about $21 billion. So if you figured the $22 billion that Berkshire may have made in gains from Apple offsets the loss in Paramount, maybe that's where you get from $168 billion to $189 billion that supposedly Berkshire Hathaway may have in cash and treasury bond holdings right now, as well as Buffett said that he thinks that the Berkshire cash pile could go to around $200 billion by the end of the second quarter, which would be about the end of June 2024. So it'll be interesting to see why Berkshire is favoring hoarding so much cash as opposed to keeping its Apple stake, because I think that's interesting that Berkshire would rather sell some Apple instead of just holding on to this incredibly great business. And Buffett reassured investors, and I'm sure Tim Cook, who was in the audience, that Apple will remain one of its top holdings as long as nothing super serious or big happens to change the fact that Apple is Berkshire's current number one equity portfolio holding. And some other things that I thought was interesting was that it's possible Buffett suggested there could be some tax reasons, like potential future tax rate hikes in the future, that could mean that maybe Buffett wants to get some capital gains taxes out of the way on having sold some of the stake right now. And even though Buffett said he's more than happy to pay the 21% or so to the government on the gains, at the same time, I don't know why maybe in the future would they consider selling more Apple at even a higher tax rate. It's sort of questionable why they're incentivized to sell Apple at the current tax rate now. And at first I speculated, I wonder if it's for some tax loss harvesting to offset some of the losses on Paramount. But relative to Apple, the Paramount stake wasn't even that big if it was give or take around $1 billion. So I know $1 billion sounds like a lot to everyday people like us maybe, but to Buffett and Berkshire, maybe that's not a big motivator. And perhaps if some of the tax rate changes that could be coming into play are being used to help address some of the US fiscal debt, I wonder why now? Why does Berkshire feel the need that it's a good time to sell some Apple and take some gains off the table? Because someone asked about Berkshire's holdings in keeping Coca Cola and American Express. And as far as I know, I don't know that Berkshire has sold any of that. They probably haven't. So it makes me wonder, why not get some gains off of the Coke and AMEX positions instead of Apple, which is arguably one of the best, if not the best company in the world to hold, aside from, say, Berkshire Hathaway. Because a quote that came up is that when Buffett said, we own Coca Cola, which is a wonderful business, and we own Apple, which is an even better business, and we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca Cola. So I kind of don't get why they singled out Apple in terms of trying to take some gains. You would have assumed that if that logic holds to get some gains ahead of some tax rate changes, that why not also cash in some of their Amex and Coke stakes? So I find that a bit of an interesting move there. And also, it looks like Apple stock wasn't hampered too much by some of this news. Like, it looks like Apple was still buoyed by some of the earnings announcements last week from Tim Cook that there would be $110 billion of buybacks. So it's sort of funny how Berkshire is okay with selling Apple, but Apple is okay with buying back its own shares. And speaking of repurchases, I think in the first quarter, Berkshire may have had about $2.6 billion of share buybacks of Berkshire-A and Berkshire-B shares, which is not all that much considering Berkshire is prioritizing having way more of a cash pile. And something I reflected on when I read Berkshire's annual letter this year is that it looks like Warren Buffett is really cognizant of a potential financial crisis in the future. Who knows when that will happen? But Berkshire wants to be a financial fortress that more than holds enough cash for anything that may happen, like companies going on sale if we have a 2008-like Great Recession again. And it makes me wonder, if there's nothing really to buy right now for Berkshire, what are they really doing with the cash? Are they just kind of keeping it in some treasuries? Because like he said, we'd love to spend it, but we won't spend it unless we think they're doing something that has very little risk and can make us a lot of money. And we only swing at pitches we like, in that he hasn't used his cash pile to make new investments. We don't use it now at 5.4%, which is what the current, say, treasury yield might be, but we wouldn't use it if it were at 1%. Don't tell the Federal Reserve, he said jokingly, supposedly. So even though Berkshire kind of doesn't want to buy all that much right now with public stocks, maybe he's buying some private companies that we don't know about. There were some potential rumors that Berkshire could be buying maybe something in the financial or bank space or even in Canada, but we won't know what that secret, mysterious buying activity is that Berkshire could be up to. So it's interesting to see what might shake out in terms of Berkshire's future investments that Buffett said will be the responsibility of Greg Abel. And I kind of think of Greg Abel as the future chief capital allocator, as Buffett has been. So some people have speculated that maybe Todd and Ted would be the key people making investment decisions, but it doesn't look like they'll be the main ones doing that. It will mainly defer to Greg Abel, who talked a lot about some of Berkshire's other businesses, like what's going on with the energy utility businesses and also with Burlington Northern Santa Fe, the railroad that Berkshire operates. So there's a lot that's kind of tricky in the energy and utility space. And there were some kind of claims going on with Pacific Corp resulting from some of the fires in Oregon. And I think that can be a little bit of a tricky space for Greg Abel to have to navigate, but I'm sure that being CEO of any company is no cakewalk. And as the future CEO of Berkshire, there's a lot that Greg Abel is going to need to deal with. And along with that, the National Association of Realtors, there was recently a settlement that Berkshire's Home Services of America had to pay $250 million toward. And Greg Abel talked a little bit about that, how there's going to be a transition and realtors are still really needed and critical to the home buying process. But what I sort of suspect is that perhaps we'll see a lot less buying agents on behalf of home buyers who, if they might stand to get less of a commission from the sellers, maybe we might see less of those and maybe there'll be more emphasis on the selling agents. So who knows exactly what's going to shake out there, but inevitably incentives are going to change in the real estate area. And in spite of that, Buffett seems to think that he was happy to pay 6% in commissions when he's had a few property purchases over the years. And we'll just have to see what might shake out from some of the changing real estate commission structure. But definitely something that maybe we'll have to look into if we're interested in buying homes or selling homes. People in real estate in general could be affected, but hopefully for those of us who might be wanting to buy a house, perhaps it will be better, or maybe it'll be even better for the people looking to sell a house, because hopefully the seller won't have to pay as much in commissions either. And hopefully it's just fair for everybody involved. So no matter where people are in the spectrum of buying and selling homes, that hopefully everybody would get their fair share of what's due to them in the role that they play in real estate. So with that, I'm trying to think of some of my other notes I had. It's interesting also to go back to Apple, that at the end of the first quarter, supposedly Berkshire's stake was around $135 billion, which has come down a lot from the $174 billion stake it had at the end of the fourth quarter. And of course, Apple has been sold lately. And I know that Berkshire took some capital gains out of Apple. So it's not clear entirely how much Berkshire took in cash. Like maybe it could be upwards of $40 billion. But I just know for sure that Berkshire has reduced its stake in a not too insignificant way in Apple. And some other cool things that I noted from Ajit Jain, he said that Geico is still playing catch up to Progressive in terms of data analytics and catching up with the technology it uses with measuring insurance and premiums. And I think that that'll be something we should pay attention to. And I find it interesting that Ajit said technology is something that has unfortunately been a bottleneck, and they're taking steps to bridge the gap. And certainly by the end of 2025, they should be along with the best players when it comes to data analytics. So I kind of wonder why, even in the insurance business, that Berkshire has been a little bit of a tech phobe. I know that Buffett is, but you would think that Berkshire should be innovating and Geico should be at the forefront of innovation when it comes to insurance, given how well they've been doing. So it seems that they've been a little bit behind the eight ball in terms of investing in the insurance technology aspect. But once they do, and perhaps if interest rates go down, you would think that the insurance business of Berkshire Hathaway will be even more booming than it currently is. So I guess it's just a matter of time, but I guess we'll see Geico hopefully catch up to, if not maybe eclipse Progressive in the future, especially since I'm speaking as a Berkshire Hathaway shareholder myself. I certainly hope that for the future of Berkshire that they'll make these improvements, and then we will all benefit as shareholders and potential customers of Geico if you use them for your car insurance. Not an advertisement, and I'm definitely not saying you should be a Berkshire shareholder if it's not right for you, but that's what I'm hoping for. Obviously, as a biased shareholder, I would want the best for the future of this company and, for what it means for fellow shareholders owning Berkshire. And another note that I heard from Warren Buffett is he thinks that artificial intelligence could have a big scamming growth industry. So it's interesting that that's what Buffett would reflect on, and how we've let the genie out of the bottle and that there could be a potential impact in the world, much like nuclear weapons has had in terms of AI and scamming. So I think that's a little interesting that we don't know exactly good or bad the effects will be of AI, but I find it telling that Buffett would reflect on scamming. And also a note with Ajit Jain, he said that they're not going to sell cybersecurity insurance because I'm assuming there's going to be a lot there that's going to be tough to handle. And it looks like maybe Ajit Jain is being especially wise and staying away from cybersecurity insurance. So good for Berkshire if they feel like cyber is not where they want to insure. That's probably a move for the best. And Ajit Jain was also talking about how Florida is a challenging place to insure, but he seemed a little hopeful about that. And finally, the last thing I want to note is that Buffett called his best friend and investing partner, Charlie Munger, unfailingly honest, which is a key part of why Charlie was one of his closest, if not closest companion. And Buffett said, when you get that in your life, you cherish those people and you sort of forget about the rest. So with that, there's another thing that Buffett said, which is he encourages us to be kind, because whether we're rich or poor, you can always be kind. And that's something that a lot of rich people don't do. So if you're like Buffett and Munger, you're going to try to be kind to people, and we want to help each other be better investors. And I think that's going to be part of Warren Buffett and the late Charlie Munger's everlasting legacy, is they had the kindness to share their investing wisdom with all of us. And I think for that, I'm super grateful to Buffett and the Berkshire Hathaway team. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.